Did you know how indebted Canadian venture capital is to federal funding? Tony Dagger knows, and he's going to tell you why. Hello and welcome to another episode of the BetaKit podcast. I am Douglas Saltis, editor-in-chief of BetaKit, and my co-host, as always, is Rob Kennedy. Today we talk about Canada's VC ecosystem, which is a familiar topic to the BetaKit podcast. But today we'll address it in greater detail and with a bit more flair. This week's episode features RBCx's Anthony Mouchantaf, known to regular listeners as Tony Dagger. Tony Dagger just wrapped up a 4-article series on the state of Canadian tech and venture capital called All That Glitters Is Not Gold. You see, while Mr. Dagger is optimistic about the current Canadian tech boom, he notes that it's built on a bit of a precarious foundation, Jenga blocks, if you will, like outsized contributions from the federal and provincial governments, crossover investments from the US driving up valuations, with potentially a painful bill due on the back end, and some broader macroeconomic trends that I fundamentally don't understand. Which is okay, because Tony Dagger does, and explains it in a clear and direct way that I wish most VCs who appear on this podcast, not naming any names, would adopt. This is a meaty episode, but also the best conversation you'll find on the state of Canadian tech and its future, especially if those Jenga blocks start falling. Let's dig in. Tony Dagger, Anthony, you've joined us again. This is the return after a brief dalliance during SAS North. Since then, you've been a busy beaver writing a 4-part series on Canadian venture, I think somewhat prompted possibly by the conversation that we had in Ottawa. And there's a lot that we're going to be going through about the state of Canadian venture and the impacts up and downstream from that. What motivated you? What prompted you to write a couple thousand words on where Canadian venture is at right now?
So first off, Dougie, it's lovely to be back here with you. Indeed, the conversation back at SAS North prompted a lot of introspection and self-reflection, as any conversation with you does. The ecosystem has some amazing tailwinds, right? Like we've seen record-shattering quarters over the past 6 or so from a financing, exits, kind of IPOs, foundings, all that good stuff. And what I kind of self-tasked myself with was to kind of do less evangelizing and more kind of an honest assessment of, where are we doing well, where are the risks, and how can we plug those risks to kind of make sure that this isn't just part of a cycle, but that we're on a kind of consistent path forward as an ecosystem. So that's really what drove it. And I think we're at a point where we have a lot of confidence and we're able to talk kind of candidly about some of the lingering exposures and how we can deal with them.
That's a good way of stating it. You don't often hear that from maybe you hear it more often from Canadian VCs, members of the Canadian ecosystem, where there's enough activity now that not everything has to be raw, but we can actually maybe investigate some optimization points or future points for concern. That very much wouldn't have been the case 5 to 7 years ago, simply because the level of activity was microscopic compared to now. But why don't you lay out just high level before we dig into the specifics? And there's a lot here. What you're seeing is kind of like the ground state of where Canadian tech, Canadian venture is at, and we'll jump from there into each specific component that we find the most interesting.
I preface always by saying it's been an amazing time to be in Canadian venture, right? For you and for me and for everyone kind of in our network and the folks we know, we've never quite had a run like this, like the one kind of in the just immediate post-pandemic quarters. So that's been really positive. As we think about where things are going and where our exposures are, I really see them as being threefold, right? And that's why, in fact, it was a 4-part series. First part was an intro. The residual 3 parts were kind of looking at what those kind of 3 major exposures are. I think the first one is an over-participation of government in the ecosystem. And we basically talked about, if you track every dollar invested by Canadian VCs into Canadian companies, what percentage of that has a natural nexus back to government programs? And we think it's around somewhere between 30 and 40%.
Which is a significant percentage.
Which is astronomical. And it's not that I don't like government, and it's in fact a celebration of government and indictment of kind of the private sector, right? Like government policy and kind of foresight is played an important part in bringing us here. But the issue is that government capital tends to be a lot more sort of transient. It depends on policy, it depends on the mood in Ottawa, it depends on a whole bunch of stuff. It's not kind of real financially driven permanent capital. And so my point with that was what government giveth, government taketh away. And so it's important for us to kind of recognize that. So that's the first kind of major exposure. I think the second one is this proliferation of late stage crossover investing in the United States, which VCs love to talk about services businesses versus product businesses. And funny enough, VC has always been a sort of services business, right? It depends on people. It doesn't scale well. You can only manage so much of a portfolio.
Become heavily commoditized as capital is increased across the board.
You're exactly right. They built indices of assets, they invest passively, and they invest at scale. And that's really disrupted venture, but it's created this private valuation inflation that we're just now starting to really grapple with and understand the kind of the ramifications thereof. What's interesting is since that part 3 came out, Tiger signaled to the market that they're going to focus on public equities and potentially move down market to A's and B's.
Because they can't find any other rounds to invest in right now?
Well, because investing at a crossover and then getting slashed 80% isn't a sustainable business model. The kind of public market bloodbath has brought this reckoning to late stage investors and this necessary kind of, holy shit, introspection. Like, is this model working? And if it's not working, how do we adjust? There's a lot of VCs that are kind of naysayers on Tiger, right? There's this conversation around crossover investors have ruined venture and all this kind of stuff. I think it's super clever. I think it's really smart what they've done. And I think they saw an opportunity in an inefficient kind of growth stage market and took advantage of it. If I'm a Tiger investor, I'm quite happy. But the thing with crossover investing is it's a portfolio index strategy, right? So if some companies perform poorly, but on aggregate the index performs well, you do well as an investor. Problem is that introduces a whole bunch of volatility for earlier stage investors because, private valuations now are a lot more sort of unstable, so to speak.
And the public market component is if we see every tech stock immediately drop like threefold because of the bloodening that's happening in the public markets. The boom cycle only continues so far as you can control the continued inflation of the valuation. I want to put a pin in that and get to the third component, which you're kind of like pointing to, which is the macroeconomic considerations, which for a somewhat myopic publication in BetaKit, which is Canadian focused, usually expands beyond our reach, but within the realm of the BetaKit podcast is juicy conversation beats to understand both Canadian tech and tech from a Canadian perspective. So at a high level, just roll out what the current macroeconomic is, in addition to the great tech sell-off that we're seeing in the public markets, and then we'll start digging into these things in greater detail.
For sure. So on the macro stuff, the important takeaway is that the Bank of Canada basically just pumped a bunch of money into the ecosystem. So for our purposes, just imagine a kind of big cargo plane dropping money down to excited investors, to cheering investors who need to figure out what to do with it. And they've simultaneously made fixed income securities or bonds a lot less attractive, right? For this discussion, the macroeconomic impact is you have a ton of investors flush with cash who are less incented to put it into bonds. So they're looking to park their money somewhere. They're looking for yield, and that's naturally kind of pushed them towards tech stocks, and it's pushed them towards alternatives in private markets like venture. The challenge there is that the kind of macro policy was really reactionary to COVID, and it's not sustainable. Again, with this concept of what government giveth, government taketh away, they pumped a bunch of liquidity in the market, but they're going to have to suck that liquidity out, right? And the expectation of that upcoming reduction of liquidity and increase in interest rates is putting a huge strain on public valuations. So that's kind of the macro piece that I think is important for kind of listeners to keep in mind.
Yeah, the course correction isn't necessarily in real time here. Let's bring that back then to the very top and talk about the reliance upon government capital in our investment ecosystem. And I think with that, probably, can you actually break down our current fund-to-fund ecosystem. This is something that BetaKit has to regularly track. We don't write about as much as I would like because most of the people we talk to don't want to be on the record for these kind of considerations. But I also think that the broader people in the tech ecosystem, they see a lot of dollars coming into companies and they don't understand who funds the funders. Do you want to break down the current circumstance where we find ourselves with 35% of all dollars invested by Canadian venture capital firms into Canadian technology companies leading back to the federal government? This is where we start getting into acronyms like VCAP and Vicky. But just give a scope from your perspective of what funds the funders.
Yeah, so I'll try to do this as succinctly as possible. At a very high level, fund of funds are institutional investors who invest in venture capital funds, not into companies, right? So VC funds have their own set of investors. They're managing money for third parties, and a big chunk of that money pool that they're managing is what's called fund of funds investors. In this country, the major fund of fund investors, there are 4 of them, and those major funds are recipients of government programs called the Venture Capital Catalyst Initiative and the Venture Capital Action Plan is what I think the acronyms are for. It's not relevant, but essentially the government made the decision in the early 2010s and ongoing into the mid 2010s to spur innovation and to support venture capital by giving money to these fund of funds managers who are experienced investors, well-versed in venture, giving them public taxpayer money and asking them to match that capital with private sources of capital and to take that money and invest it in venture capital firms. And that's it. That's basically what they've done. And so when we say, why have they done it?
Yeah.
They've done it from the government's perspective to spur innovation. I kind of air quote it there, but it's genuine, right? It's creating new industries, new companies, creating high knowledge jobs in the economy. The more kind of existential why is because our private capital markets haven't developed sufficiently to support that growth in and of themselves, which is honestly unique to Canada in many ways. We're behind the US and Western Europe in that kind of arena.
And there's also a mitigation of risk, is there not? Which is if you're matching your dollars with their own dollars, the risk is smaller, lower. It reduces the risk for Canadian fund of funds. If I only have to put up 50 cents on the dollar, doesn't that mean that I get more for my money? So if it all goes to hell, then it works out for me?
Yeah, I mean, if it all goes to hell, well...
if it all goes to hell, you lose half as much.
That's what I'm saying. Is like, are we not relatively risk-averse as a society, as an ecosystem? We're risk-averse with our investments. And so if the government takes a bunch of that risk by putting 50 cents or something on the dollar, that means I can take a risk and not bet my entire house, just half of it. No?
So it's a really interesting question. I disagree with that assessment. And the reason I disagree with that assessment is that I don't think that it's a failure of private investors not wanting to take risk. I think it's a failure of our private capital markets not giving private investors what they otherwise want, right? In other words, I don't think that investing in a fund of funds is particularly risky, particularly in the kind of 4 funds that make up the fund of funds ecosystem in Canada. And the reason I say that is that they're established managers and they're highly, highly diversified. It's Terralis in Quebec, Northleaf, HarbourVest in Kensington, right? I consider world-class funds, great managers, all of whom we know well and who
most people would not be familiar at a name brand level, but if they are regular and deep readers of BetaKit, they will see those fund of funds mentioned as LPs when we note Innovia, Panache, or whomever have closed new rounds. That is the fund of funders component.
Yeah, and major players in the ecosystem. They manage a lot, like more capital than probably the largest VC fund, with the exception of maybe Georgian. But they manage a lot of capital. They're very influential, and they're very experienced individuals and investors with long track records. And they're investing in highly diversified securities. So if you think about the risk of investing in a startup, and you hear the typical trope, 9 out of 10 fail, which isn't entirely true, maybe at the pre-seed stage. There's one level of risk in investing in an individual company. There's a different level of risk investing in a portfolio of companies. And then there's a whole other level of risk investing in a portfolio of venture capital funds with their own portfolios across stages and across sectors, right? So essentially what you do, if a fund of funds is done right, you're investing in a basket or an index of Canadian innovation. And so that's why I actually don't think it's too risky of an instrument for private investors. I think the issue is that today, if you guys, the two of you guys, go to your wealth advisor and you go, hey, like, I'm bull on Canadian tech, like, get me some exposure to the asset class. Your advisor is going to throw up their hands and be like, well, we can't do that. That's not available to you. That's not true in the United States. It's not true across parts of Western Europe. And then when you aggregate that, when you have infrastructure and rails to allow people to get access to the asset class, when that compounds, you have a completely different capital markets landscape.
Is that a legislative thing, like we've talked about before, in terms of the certain conditions that you have to be at to, like we saw this happen with AngelList coming to Canada and like the accreditation system? Is it literally like legally certain people are blocked out from participating, or is it more of a culture ecosystem network of, the family office knowing where to go to meet tech companies? Other than, say, reading betakit.com every day?
It's a mixed bag. It's more the latter, right? So there are regulatory or legislative restrictions, let's call them, but those are generally consistent across jurisdictions in Canada, US, and Europe. And that's the accredited investor rule, which I talked about. And my view is that, and this sucks to say, I'm proud as hell to be Canadian. Like, I love this country and I think it has a lot of amazing things, but I think venture is weirdly offensive to Canadian sensibilities at scale. People just don't like it. They're kind of uncomfortable with it. They're like, like tech startups, like you think you're going to grow so fast, but venture is so risky. There's just a general perception that it's not a priority in this economy and that it's not an integral part of an investment portfolio.
Why would we do that when we have real estate and natural resources?
We've got mining, we've got oil, we've got all sorts of stuff. The same is not true in the US, right? Like, you need to get access to tech in the US. Otherwise, you're not doing a good job of it, right? You need access to the asset class. The reasons for that I can get into. I think they're sociological.
They're far too cultural, and we don't want to be talking about Canadian heritage moments at this point in the conversation. I want to go back to the point where you talked about the government's role in this, where they're saying to counter this, to spur investment innovation, they're willing to say, if you were to pull up capital, we will match that 1-for-1 as a catalyst, to refer to the name, for investment. Now, you had noted that VCAP and VCCI are two acronyms that we can put aside, but I want to note some historicals here, because VCAP was the program under the prior Conservative government, and VCCI was the slightly rebranded implementation of the program under the the continued Liberal government, which had some very specific differences in how the payout terms of the money given from the government to these fund of funds happened, which I think impacted which fund of funds decided to pursue Vicky money and which fund of funds decided not to, as we've kind of reported on BetaKit. But also with that, there were additional considerations related to specific phases of Vicky dedicated to investment in diversity, specifically women in tech. There are some distinctions between the broad function of the program and how it's been implemented by certain governments. Before getting back to your point of, this is a very significant percentage of where capital is coming from relative to Canadians investing in Canadian tech. As you noted, it cometh and it goeth. That's a 1/3 is a significant chunk that could disappear with a new government or a new government mandate. I'm wondering if part of your prompting for writing this and having the conversation with us in November was more about, hey, mathematically, this could be a problem because we might be over-indexed on this underpinning this amazing growth that we're seeing, versus whether or not you are hearing some of the things that BetaKit is hearing in terms of the current government's commitments to re-upping Vicky at the level they announced in last year's budget versus additional earmarks related to certain reporting as it relates to diversity of the founders that get invested into, or other considerations that might actually lead to funds who are expecting Vicky re-up for their next fund to suddenly say, this is not something we're going to be looking to pursue. Are you seeing the same tea leaves that we're seeing as it relates to the current government conception of how successful from their end the Vicky program has been and how it might continue?
So I have no insight that's not in the public realm, right? So I don't know anything that you don't know, Doug. And if anything, you know more than I do. What prompted the conversation is just this kind of weird aha moment where kind of from my vantage point, I'm starting to look at the ecosystem and eventually I just go, holy shit, like this is just a massive, massive concentration, right? It's a massive bottleneck. And it's not just a bottleneck in the sense that if you extract that government money, that activity slows down. It's a timing bottleneck too, right? It's that it needs to coincide with government money being in the ecosystem so that funds can then raise money or have enough access to capital to close funds. It's this massive underpinning of the whole system. So that's really what prompted it. It's this kind of appreciation for, wow, like this is...
We are all living in a Jenga stack.
We're living in a Jenga stack, but we have an easy remedy, right? Like easy again in air quotes. Like the issue is that I reiterate, I don't think that private Canadian investors don't want access to tech. I think it's big Canadian institutions are not there yet. They're not ready to invest in venture, and because of that, government has had to kind of pick up the slack. That's the unfortunate piece. I always preface when I talk about this stuff is that it comes off as like me being like, screw government. We need less government. And it's really not. It's a celebration of government. Like BDC and these government programs have propelled the ecosystem here in spite of a relative lack of imagination on the part of the Canadian private sector. I think it's just too small now. I think if you look at kind of the origin of VCAP and Vicky, we were in a very different place. I think VCAP was 2013. And Vicky was 2017, but I think that's kind of roughly when these programs were launched. And the ecosystem was a very different place at the time. These kind of fund-to-funds managers were really doing this quasi for the first time in this kind of public-private partnership context. But now in 2022, they go, hey, listen, like we have a track record of deploying taxpayer capital at scale and beating S&P 500 returns many times over, creating tens of thousands of high-paying, knowledge-based jobs, and creating potentially generational companies within our borders. So why cap it to whatever it is, 450 million? This is probably one of the most successful government programs we've ever created and launched. Let's double down on venture. And then finally, this is really important. This is where I touched on the macro piece without getting into too much detail. Because we're in an environment now where money's being sucked out of the system and interest rates are going up, there's a really strong counter-cyclical argument to be made here for fiscal policy offsetting kind of monetary contraction, right? So if we're going into an environment where there's going to be downward pressure on valuations and there's going to be pressure on VCs raising new funds, then it's perfectly appropriate and necessary for government to step in and go, okay, given we're entering this kind of contractionary environment, we need to accelerate Vicky and double down from a fiscal standpoint to make sure that we don't hit any hiccups or any bumps in the road as the Fed and Bank of Canada kind of readjust their balance sheets.
Hey, in a complete coincidence, the presenting sponsor of this week's episode is RBC Ventures. RBC Ventures is on a mission to redefine how banks can transform the way consumers live and businesses run. Its portfolio of scaling companies focused on reshaping industries from real estate to healthcare to public transit and making lives better for newcomers, youth, and business owners. As part of a growing team within Canada's largest bank, RBC Ventures is looking for people to design, market, code, and more. So you can start building for big league impact with their unique, tight-knit team and find your next role at jobs.rbc.com/ventures. Hey, the Beta Kit podcast is also brought to you by Venture for Canada, a national charity that fosters entrepreneurial skills and mindset in young Canadians, which is hosting its first annual All Things People conference from March 24th to the 25th. This virtual event is designed to help small to medium-sized businesses, HR specialists, and anyone interested in scaling diversity and belonging, putting the people first in people operations. The All Things People conference brings VFC's vast network together to openly and candidly chat about practical and system-shifting steps Canadian startups and innovators must take to make the most of lessons learned from this moment. So you can head on over to www.ventureforcanada.ca/conference to learn more and get your tickets today. Bonus, we are offering you a special discount code for your tickets. Use the code BETAKIT10, all caps, to get 10% off your ticket purchase. And when you attend All Things People, let them know BetaKit sent you.
Aren't we in danger, given the natural headwinds that exist in Canada that you mentioned, given the inflation that's coming, given companies like Canadian Shield being like, we can't even procure from our own country if we tried.
We can't buy or sell in Ontario.
We can't make stuff still. We still export all our metal to be made somewhere and then sold back to us.
My partner would let me buy grapes this week because they were twice as expensive as they were a month ago.
Right, but drinking them, that's fine. So I guess my question is, are we at risk of doubling down on the thing that we should be trying to at least hedge away from? Because it's easy.
I don't think that's sustainable, right? Like, I think
within the context that you as a VC argued for, I'm sure that every fund and fund of funds is very much saying, Vicky has been an incredible success, even though half the company or half the firms in the third deployment of it backed out and never actually accepted the capital. The returns are great. Federal government, why wouldn't you want to re-up on this and keep the good times flowing? Given that the federal government has a variety of different considerations across the board, whether it is war in the Ukraine or insurgency in our nation's capital, things like that, would their perspective not be one, perhaps, where they're saying, we did the thing, we seem to see tech all over the place, you don't need this anymore, it's now time for these institutions, let's say the major banks in Canada, not going to name anyone specifically, to step up and be the fund of funders, because our capital needs to be deployed to, actually providing clean drinking water to a large portion of the people that we promised that would happen for. Is not the government counter argument that they are no longer needed to incentivize this and it's time for the private sector to step up?
So there's a few ways to answer that. Yes, in the sense that I agree with you. And my point has consistently been the private sector needs to play a bigger role in this. And it's something that I think will happen gradually over time, and something that I'm personally obsessed with. And I think that a lot of kind of major institutions in this country are starting to wake up to. It's true of the banks. It's true of asset managers. It's true of everybody. So that's the first thing. So I think you're right from the standpoint that ultimately we want less government money, certainly proportionately, and more kind of private capital, sort of quote unquote bankrolling innovation. But I think if you're going to be pragmatic about it in the immediate short term, I think if you extract government money from the system too quickly, then the whole thing comes tumbling down way too quick. You quit cigarettes with a nicotine patch. You don't kind of go cold turkey. And I think this is kind of a similar thing.
Particularly if you're already at the counter looking to buy your next pack, which I think most funds determined upon the cycle of the last Vicky would be at.
So I think that's fair, but where I would challenge both of you guys on this is this program is probably one of the most impactful programs that the government has ever launched for all Canadians of any stripe, and for the future of our country from a kind of economic independence and kind of innovation strategy standpoint, right? By doing this, the government has enabled us to invest in high tech, new technologies. We've been able to attract talent to the country. We've been able to create kind of going concern, generational, sustainable businesses. And most importantly, the fund of funds have driven returns to the taxpayers, right? You have to emphasize this isn't an expense. This isn't an expense. It's an investment that's wielded S&P shattering returns for the taxpayers. So all of that in context, I think, is really important. And finally, if you're going to talk about what's the kind of overriding societal impetus here, what's good for Canadians, right? Because government needs to think about it from that standpoint. Vicky this time is allocating something like $50 million to life sciences, which is peanuts in something that's been shown to be at the core of our national security. It's like we learned nothing from this. Like we couldn't manufacture our own vaccines without getting into kind of that conversation.
No, I will refer our listeners to the multiple podcasts we've recorded.
Yeah. So if we're going to name the fund of funds by name, like if you take Terralist, for example, right, who are good pals, and I'm a big fan of that shop, and I know those guys really well. And they were involved in several of the highest profile Canadian venture capital funds. They've been involved with some of the highest profile US venture capital funds and any venture capital funds in the world. I'm talking life sciences specifically. So they were in several of the kind of breakout life sciences businesses in the country. So that is massively, massively material in the context of Canadian life sciences and of our ecosystem generally. And they've done that with 1/3 government and 2/3 or whatever the kind of matching kind of private portion is. So again, I go back to this point where you have like really established fund managers across the Vicky funds, demonstrable track record of, and again, like any venture investing is impact investing to some extent, which is something I always say, right? Like you're not buying secondaries, you're not buying mature businesses, or you're buying from treasury and you're building businesses and you're creating jobs. So that's kind of my rebuke to the shouldn't we be focused on other stuff. I think we can kind of walk and chew gum at the same time.
Rob, do you want to speak on behalf of the federal government now?
Oh, absolutely.
Rebuttal.
Rebuttal. Well, actually, no. I'm curious then. So the motivation, sort of the knock-on effects of who your LPs are with approximately 35% government and stuff like that. You mentioned it before, the Peter Thiel, the 0 to 1, 9 out of 10 businesses fail, blah, blah, blah. They're looking for unicorns. If you're an entrepreneur in Canada, you're trying to pitch a VC, you're like, gotta be a unicorn, buddy, a unicorn. Sounds like the calculus, because of who the funders are in Canada, is different. And the motivations are different. Is that true? And how should an entrepreneur who's thinking about Canadian venture, do they pitch a Canadian VC differently than an American because the motivations are different?
So the short answer is probably, but I don't know. What's certainly the case is that VCs pitch investors differently in Canada. Because VCs understand that a big chunk of the ecosystem's fund capital has non-financial motivations, they need to adjust their pitch to accommodate that. So I'll give you an example. Some Vicky requirements are that a certain percentage of capital be deployed in Canada, right? BDC, for instance, is an active fund of funds investor. They require certain percentages to be deployed in Canada. So naturally, if I'm fundraising and I'm a VC, I'm going to be like, okay, well, geographically, my strategy is Canada, or my strategy is 50% Canada, or whatever the case may be. That alone is going to color kind of your deployment strategy. Then there are things like deploying capital into underrepresented groups, for instance, which is a really good thing. And that spurred the creation of some of these, funds that are focused on, women or
Women in Tech Fund. We've covered this in 2016, the whole spin out and the change there, where there were suddenly terms earmarked to funding, and they had to, I would say, scramble to spin up that fund and find enough women-led companies. Remember, not necessarily women-founded, but women-led companies to invest in while they were spinning out a variety of funds out of BDC.
And then I think, so that's on the venture side. I think on the company side, like there's this trope, right, that Canadian VCs are just more price sensitive than their kind of US counterparts, and that, they're more conservative than their US counterparts. That's totally true. That's totally accurate, right? And it is. It 100%
no, it's just the way you started that sentence made it sound like you were going to say the opposite. And you're like, oh, it's so funny.
We had this whole segment where we were going to gotcha with that and like hit you with some numbers, and you just admitted to it, which is classic Tony Dagger play.
Yeah. I don't know if that's because of the government, though. I think that's probably more, again, cultural.
Well, let's break this down, because it points to your second consideration on the macroeconomic stuff. You basically said there are three distinct, largely independent phenomena propelling the current boom that we're facing. Maturing ecosystem, we have spoken about in great detail. Those transient macroeconomic abnormalities, which we're kind of touch upon, maybe can dig into more, or refer you to LinkedIn article we will have in the show notes if you want to dig into that stuff. But the major one here is the proliferation of crossover investment strategy in the United States, which I will take as a proxy for the huge invasion of U.S. capital into the Canadian market, because if anyone has read any of the quarter-by-quarter reports that we've been covering and producing in conjunction with Briefed In, the growth that's getting us to billion-dollar quarters in Toronto and the BC ecosystem is not being fueled by Canadian investors in Canadian companies. It's being fueled by foreign investment in Canadian companies. So I want to go back to this thing that Rob was kind of alluding to, which you kind of admitted to, which is you are concerned about valuation inflation and instability in early stage portfolios, predominantly due to the US inadvertently creating this. We literally just had Ryan Holmes on the podcast saying, if I were raising money for Hootsuite based upon our 2008 numbers, our valuation would be like 5 to 20x versus what we got in 2008 when literally Omer's Ventures was the only game in town. So I'm wondering if you feel like, noting that you are a VC working for a bank, how much this is valuation inflation or right sizing between cultures given the additional optionality that they have now. How much of this is Tiger Global coming in, just pumping everything up versus the fact that like Canadian founders don't have to go to Canadian VCs anymore to get around, and they can raise around in Canada and not have to reincorporate in the US to get US capital.
So I'm going to try to unpack that a little bit.
Do it. You already admitted that we're right, so there's no gotcha moment here.
There's
right?
a lot.
So
there's a lot there. Valuation like emanates from a like kind of web of interconnected factors, right? Like there's a few ways to think about it, and it ultimately kind of reconciles to some valuation, both on a micro level for companies and at a macro level for a bunch of different companies. Within that web, there's really kind of three frameworks, and stick with me because it'll pay off at the end here. So there's kind of three frameworks there that kind of are codependent that create kind of some market clearing price. The first is, call it like intrinsic value or academic value or whatever. And this is basically the sum of the cash flows that the company is going to generate over the course of its lifetime, which is completely useless because we don't know what that's going to be. It's highly variable, but it is helpful directionally. And that's why companies will jump in valuation when they have a blowout quarter and they're growing really rapidly, or why low interest rates will plug valuations with no other kind of change to fundamentals and vice versa.
We're waiting for your EBITDA is a lie series.
Yeah. So that's just the intrinsic value. So there is some intrinsic value to the company, and it's the sum of its future cash flows discounted. You know this shit. The other big thing is what I'd call kind of the practical value of a company, and that's really just what people are willing to pay for it, right? And there's a big psychological element there, but there's also just a supply and demand for cash, right? Like in an ecosystem flush with cash, you have a really hot company, kind of charismatic founder. A lot of people want to put money in. It's going to drive up valuation. And that's probably part and parcel with why US valuations are higher. It's just there's more capital chasing less deals. And then the last piece of that isn't really a way to value companies. Every smart VC on the planet does this. And this is just multiples benchmarking. And this isn't valuing the company. This is just doing a gut check to make sure you're not like grossly overpaying for a business. And that's taking companies that are similar to yours, looking at public multiples, because these are, pre-profit businesses. They're, top line, doing a multiple and seeing if you're kind of paying like roughly what the market going rate is, right? And from those three factors, like something kind of emanates and pops out into a reasonable valuation. That's kind of the best way to think about valuation. What Tiger's done is, and I say Tiger as a kind of catch-all for crossover investing and kind of the proliferation. So this is Coatue and all their kind of peers. I think essentially what they did is they realized that the VC model at the growth stage was hyper inefficient, right? Like you have growth stage businesses that are mature with good infrastructure in place, great advisors in place. They're growing rapidly. They don't need kind of VC coaching and mentoring or whatever. They just need like capital quickly so they can do what they need to do. And they also notice that VCs are active managers, right? That's why they charge a 2% management fee or some management fee. It's because they take seats on boards, they roll up their sleeves as the story goes, and they help their companies hit their milestones and get to exit. What these guys figured out was that the model doesn't really make sense at the growth stage. And they go, okay, here's our value prop to founders. We're not going to take board seats. We're not going to burden you with months and months of diligence. We're just going to build an index of what we think are the best companies, give them great valuations, and get out of the way. Passive investment. We can manage a lot more capital that way. We can deploy a lot more capital that way. And because we're doing it at scale, it's okay if we overpay for individual companies, because there are still kind of VC dynamics at play, right? Like, well, if you invest in Facebook at its pre-IPO round and you hold the stock because you're a crossover investor, you have public strategies too, right? You'll just hold the stock. You don't have to. Then it's okay if you overpay for 10 other companies. You're still going to drive, boatloads of cash on that one investment. And so what they figured out is, and this goes back to what I said, is VC was a services businesses historically, right? It didn't scale because it was dependent on headcount. It depended on how many partners you had, how large their portfolio was. And these guys just productized it. They go, okay, like forget the services model. We're just going to spray capital for great growth stage businesses. We're going to do great. Our investors are going to do great. And it's a portfolio strategy. So it's okay if one of them flames out. That's totally fine. The problem, though, is that historically, private market valuation, so the way VCs value companies is they'll look at the most recent round led by some independent party and they'll carry it at that value. And historically, because growth stage investors were still kind of hands-on, they had like relatively concentrated portfolios, you could kind of hang your hat on that valuation. Probably the company's worth somewhere in that neighborhood. They probably looked at multiples. They probably looked at the kind of like growth rate. But then Tiger and these guys come in and they just blow the whole thing up. And you now cannot rely on these valuations anymore. So yeah, like in an intermediary sense, companies are getting crazy, crazy valuations. But when you're worth more than $1 billion, it's hard to find a buyer, right? So you got to exit into public markets probably. And when they're getting into public markets in this contractionary monetary environment, people are going, it's not worth what the investors paid for it. So if you're an investor in one of those companies, you're getting killed. If you're in Tiger, though, you're okay because you have a kind of diversified portfolio. So that's the kind of crazy challenge and the volatility that they've created in late stage venture that we're still figuring out how to deal with.
So would you say it's not necessarily that the math is wrong, it's that the math is different? And in an ecosystem where everyone's operating with different math, it creates conflicts. One of the things that we've heard from Canadian-based VCs is that they're less concerned about companies in their portfolio that missed out on raising a round recently when capital has been just like fun money, and more concerned about the companies that raised, not necessarily the growth stage, but like in that, again, people are raising multiple A rounds right now. It makes no sense. None of the labels matter. Who raised in the last 12 months, who 12 months from now are going to be staring at different math, different conditions, and having to explain why this is a flat round or a down round. They're much more worried about the justification that's coming after taking that money. It's because not everyone's operating on the same calculus
100%.
anymore.
100%. It's because everyone's taking the Tiger write-ups. And the Tiger model doesn't assume that all of them are worth what they're paying for them, right? That's the core issue. So you just don't know anymore, right? And the problem with that, and I've been very specific with, and I told you this too, I don't know if I'm not saying we're in a bubble because this isn't like the 2001, right? Like you have like really robust, fast growing, high margin, product market fit in big ass markets doing really amazing stuff. And they may not be worth what Tiger paid for them today, but they will probably be worth that in 2 or 3 years. The issue, though, is that because of this kind of financial volatility is you just don't know if the contagion spreads, right? Because there's a lot of psychology here, right? Like hot companies raising at larger rounds at higher and higher valuations, they suddenly raise at a flat round and everyone's kind of going, holy shit, what's going on here? So like human psychology plays an important role with this. When you mess up the kind of underlying to such an extent, it just gets too crazy. So I'll tell you right now, like good LPs kind of worth their salt. No one's just taking paper write-ups at face value, right? Everyone's now kind of having to do their own analysis going like, is this thing worth what crossover investor paid for it? What does it do in public markets? All that kind of stuff. So it's a brave new world.
We had an AMA last week or 20 years ago. I don't remember. One question that came up, I think it's a great question, and it's a great segue from what you just said. Do private valuations get affected because of the corrections to the market, because of these sort of epic changes with the way that investment is happening? Or do they just inevitably follow whatever the public markets do because of those psychological follow-ons? Or is it sort of independent, or is it always there and is going to lag?
Short answer is yeah, like it follows public. This is a weird conversation. Like I've seen this a lot in the ether, like in the kind of dialogue among like a lot of folks are like, oh no, public multiples don't impact private company valuation. And it's like, guys, this isn't
How could they
This
not?
this isn't like
connect first the correlation, right? Because you're talking about a couple of things here. Very concerned about what happens if the government doesn't match or extend previous support of fund of funds. You're very concerned about Tiger Global being a disruption in the market, forcing companies to chase valuations at math that doesn't relate to their investment portfolio, which will lead to, in the next 12 to 18 months, a lot of companies garroting themselves over their hyperinflated valuations because they chose the wrong calculus for the moment, or they're unable to find the more tiger-like capital. And then we're talking about the public markets just garroting companies to the point where we've broken news on BetaKit about companies that were, again, high margin, like ready to go, like Hootsuite. We're going to squeeze out a IPO before the end of the year and then immediately pulled out. We've seen Dax Da Silva, who has been at the head of Lightspeed for like 2 decades, lose his job. And we've seen Shopify have a only very, very good, not crazy pandemic amazing quarter, and their share price has dipped 60% in the last 8 months. We all know there's a correlation. What is the timeline related to that impact?
So the interesting thing in private markets is that it's always on a kind of rolling basis and there's a long tail to it, right? So if I just raised in 2021, I probably have 18 to 24 months of cash. So I'm not going back to fundraise until that happens, and I hope kind of market conditions change. Now, the reality is though, like things revert back to the mean, right? And like they're not going to go back to 100% multiples on public companies. So when you ask, do public multiples impact private valuations? Let me put the question back to you. Let's say you guys, you, Rob and Doug, you run a VC fund.
Yeah.
And I'm pitching you on
We tried to take our podcast public and our lawyers literally told us not to do that. So why not a VC fund?
So you're running a VC fund and you're savvy investors, right? Like you're very thoughtful, you're very insightful, all that kind of good stuff, right? And I am a startup founder and I come to you and say, hey guys, like I have $1 million in revenue. I think you should pay 50 times revenue. So I want a 50 million valuation. And then you go and look at public markets and you see that companies like me are trading at 20 times revenue. And I tell you I'm going to IPO in a year. Do you make that investment? Probably not.
Wait. What's Tiger doing?
I was going to say, where did you buy your revenue from? That's a very bad question. The word that you didn't say was Web3, which would obviously change everything, right?
That's 200 times multiple.
Well, I guess, so one of the things, again, that Ryan Holmes noted to us was that investors need startups as much as startups need investors. What you're seeing in, whether it's being caused by the Tiger Globals stirring the drink or the fact that water will find its level, and in the US market, the cup overfloweth and has been spilling into Canadian companies because they need a place to put the capital. If they can't find enough US companies, what they consider to be US light, a couple hour flight away, that pressure to deploy capital, because you must to get your returns, will continue to drive that activity. And if everyone is crazy enough to justify a price, then that's just the new reality. As you said before, kind of leverage is what you can get. And if everyone commits to insanity, then we have an insane market. And that is a bubble, even if it's a bubble predicated on revenue generating companies. It's just not the 2001 bubble, it's the 2008 bubble, where assets, which are assets, are being hypervalued past the point of anyone's capacity to control, contain, capitalize upon that value. So if any air deflates, the whole thing goes. So
the answer to that is that investors need to deploy capital. They don't need to deploy capital in startups, right? And that's an important distinction. Okay, so think about this from the perspective of opportunity cost and from a capital allocation standpoint, right? Like if I give you $1 million, Douglas, and I go, invest this to maximize your returns, you can invest in whatever you want. You can invest in startups, you can invest in real estate, you can invest in fixed income, whatever you want. Here's $1 million, right? And this is the point that I'm making with the macro stuff, is that what the Bank of Canada did is incentivize investments in startups, right? If you take the risk-free alternative to investing in a Web3 company, right? You could take the Web3, you could invest $1 million in a Web3 company and say you think it'll take 10 years to IPO or whatever. You'd also put your money in a US government bond, 10-year government bond, Okay. If that bond is yielding you 1% interest, then you're probably not super excited about it. You go, yeah, you know what? I'll take the flyer on Web3. What if it's yielding 2%, 3%, 4%, 5%, 6%? What if the Web3 company is now you're thinking, it's actually probably really overvalued. I don't think the return profile on it is that great. Then maybe your calculus starts to change, right? The reality is you have $1 million to deploy, but you can deploy it anywhere you want, and you're going to be incented by market conditions and what you perceive to be overpriced or underpriced assets.
Can most VC firms actually deploy in whatever they want, or are they structurally committed to deploying it in certain at a fund-to-fund level?
Great question. So VCs can do it, but like VCs are beholden to their investors. So fund-to-funds investors don't need to deploy in VC, right? They can go, I don't like VC as an asset class. I want to put more money in private equity. And this is why this upstream thing is so important, although it's very opaque, is that there's a lot of stuff happening kind of behind the curtain that startup founders and even VCs aren't entirely seeing, but that's directly impacting everything kind of downstream. VCs are in the business of investing in startups, but if big money managers aren't hot on startups anymore, then VCs aren't going to have access to capital, and it'll dry out at that layer, right? So this is why I think I was kind of harking on getting a bit more awareness of what's happening kind of upstream.
It just seems Jenga blocks the whole way down, and it seems like what you're saying is we are very rationally approaching a doomsday-like Jenga scenario where the whole tower tips. I'm wondering because
that's not what I'm saying. That's not what I'm saying.
But let's recontextualize this and maybe close on this, because we've talked about whether it is the government falling through, whether it is macroeconomic conditions creating venture investments to not be as suitable as return, or just the fact that U.S. capital or cocktail stirrers like Tiger Global are just mussing up the math to create very frothy considerations. What is leaving you optimistic or continue to be excited about this space when you're currently tracking a couple different homing missiles that are aligned to a target of ending the boom times? Are you seeing something other than what could only be considered a major course correction, which is maybe particularly scary given how much you've noted Canada's economy is being driven by this stuff right now? Like, what's keeping you optimistic on this?
So I'll try to offer a different analogy from the homing missiles. It's more akin to like a plane hitting turbulence. We're hitting bumps, but we'll get through it. I think what I've kind of anointed myself to do is just to put my hand up and say, look, like there is going to be turbulence, but it's okay. And I think maybe this is somewhat of an oxymoron. I think the reason we're okay is that there are amazing companies that are overvalued, right? That's at the core of it is there are amazing companies that are going to continue to scale, that are going to IPO, that are going to be around forever, and they're just overvalued today. It's what's important though is to just recognize that that's the case. Recognize that we're going from an unprecedented monetary boom cycle to an unprecedented, probably monetary contractionary cycle, and recognize that the crossover strategy now is migrating itself a little bit, and there's going to be less capital at that stage. And within that context, I think we need bigger Vicky allocation to kind of smoothen some of that turbulence. And then beyond that, I think the Canadian private sector has to do its fair share in maturing our capital markets to ensure that there are alternative sources to capital in the long run, and that the ecosystem is resilient enough to absorb precisely these types of shocks. But I think it's going to be okay. I think there's going to be some gnarly stuff happening over the next kind of 18 to 24 months as these big mega rounds start to kind of spend the capital in their war chest. But I'm overall optimistic. And I think the public correction is just about done. And this is without getting too technical. I think bond yields are probably at the right place. Like, I think the worst of it is probably over, other than kind of companies going back to market for potentially a rude awakening. But I still think there's a lot of reasons to be optimistic, but self-aware.
Okay. So like to sum up, RBCx thinks your company is overvalued. If you take money from Tiger Global, you're actually ruining it for the entire ecosystem. And Hootsuite will IPO this year.
Yeah,
Anthony,
never doing a podcast with you again.
Super appreciate you taking the time to break down the 4 different articles you've written, so we can put words in your mouth and then accuse you of doing the exact opposite. We'd love to have you back on, or be a platform for future writing that you do as you look to track what's happening. And I think, honestly, from your position, help open up a conversation on things that are often closed door private conversations that many people in our ecosystem benefit from having out in the open.
Thanks. I appreciate the kind words, or what I'll choose to interpret as kind words. And yeah, let's definitely, we'll do this again for sure. So.
Awesome, man. The BetaKit podcast is produced by BetaKit Incorporated. It's edited by Katie Lohr, and its hosts are Rob Kennedy and me, Douglas Saltis. To learn more about how you can support this podcast, head to patreon.com/BetaKit.